Welcome to the deep dive. Today we're going to be really taking a deep dive into winning the loser's game.
Oh yeah, this is a classic.
It really is, and for our listeners out there, if you're feeling a little bit maybe overwhelmed by the complexities of the market,
Right.
this is the book for you.
Yeah.
And we're going to be talking about why it's earned so much praise, like some really incredible praise,
Yeah.
and more importantly, how its insights can really help you kind of take control of your own financial journey. So to kind of give you an idea of the level of praise we're talking about here,
Yeah.
F. William McNabb III, former CEO of Vanguard, he called this book the best book on investing, period.
Wow.
Right. I mean, come on, that's pretty huge.
That's high praise.
Yeah, and David F. Swenson, who managed Yale's endowment, he said it's required reading for every fiduciary.
Yeah.
And Seth Alexander, who heads investments at MIT, said it's as relevant today as ever.
Yeah.
So we're talking about some pretty heavy hitters here.
Heavy hitters, heavy book.
Yeah. So, and the author, I mean, talk about background, Charles D. Ellis.
Yeah.
I mean, this guy is not just some, armchair expert.
Right.
This guy founded Greenwich Associates, a global consulting firm for financial institutions. He's taught at Harvard and Yale and was chairman of the CFA Institute. So, I mean, talk about investing street cred, right?
He's got it, and he's worked with some other big names in finance too.
Yeah, yeah.
Like Burton Malkiel, for example, co-authored The Elements of Investing, The Index Revolution, and Capital, the story of long-term investment excellence with him.
Right. So
This is a guy who knows his stuff.
he's got the background to back this up.
Yeah.
And I think one of the things that makes this book so brilliant is that he really is passionate about making investing accessible to everyone. It's not just for, the Wall Street insiders. It's really for everybody. And that kind of leads into one of the things that makes this book so brilliant. It takes these complex and, let's be honest, sometimes kind of intimidating ideas
Oh, yeah.
about investing
Definitely.
and breaks them down into these kind of understandable concepts. And I think, you and I were talking before this about the whole concept of the loser's game versus the winner's game.
Yeah, that's such a good framework.
Right.
Because it really helps you just wrap your head around the basic idea. It makes it more accessible.
Yeah, it's kind of like he's giving you a cheat sheet for navigating the market.
Yeah. It's like, here's how you can win, basically.
Right,
And here's how you're probably going to lose if you keep doing what you're doing.
right. So all of this starts with this brilliant analogy about tennis.
Okay.
And he talks about tennis played by amateurs versus professionals. So picture, like, you're watching a match between two friends just playing for fun in the park or whatever.
Right.
Who usually wins in that scenario?
I mean, usually the person who's making fewer mistakes, right?
Right.
They're not necessarily hitting these awesome shots.
Yeah.
But they're keeping the ball in play, and their opponent is the one who's kind of, getting frustrated and messing up.
Right, exactly. But then picture a professional tennis match.
Oh, yeah.
Like you're watching Wimbledon or something. I mean, these players, they are at a whole other level.
Whole other loves.
They're not making those kinds of unforced errors, so how are they winning?
Well, I mean, they're forcing their opponents to make those errors, right?
Right.
They're putting the pressure on, they're aggressive, they're waiting for that opening, and boom, they've got you.
So how does tennis relate to investing? This is where Ellis kind of blows your mind,
Yeah, right.
because he's saying the stock market is a lot like professional tennis. It has become this incredibly complex game that is dominated by institutional investors.
Yeah.
I mean, they have massive resources, cutting-edge technology.
Yeah.
They've got teams of analysts, fancy algorithms, and access to information that, I would never even know existed.
Oh, me neither. That's a whole different ball game.
Right. So he's basically saying that going up against these institutional investors, as an individual investor, it's like stepping on the court against, Serena Williams. You might get lucky with a few good shots, but ultimately you're playing the loser's game.
Yeah, you're playing the wrong game.
Right. And he's not saying this to be mean or that individual investors are, stupid or incapable.
Right.
He's simply acknowledging that the game has changed.
Yeah,
And to succeed, you need to play a different game.
exactly. You need a different strategy. You got to evolve.
And that's where the winner's game comes in.
Yeah.
So what does that look like? Well, Ellis says it's all about shifting your focus. Instead of trying to be smarter than the market,
Yeah.
which, let's be honest, almost an impossible task.
It is. It really is.
You focus on what you can control. So You can control your own behavior. You can control your risk tolerance. You can control your long-term goals. You set those things.
And those are the things that are actually going to make a difference in the long run, right? Because, the market is going to do its own thing. You can't control that.
Right.
So you got to control what you can control.
And that's where a good financial advisor can come in, right?
Oh, absolutely.
They can help you really understand those risks.
Yeah.
Set realistic goals, because sometimes I think we get a little ahead of ourselves,
We do. We want it all, and we want it now.
Exactly.
But it doesn't work that way.
It doesn't.
Yeah.
They can help you create a plan that is really aligned with your individual circumstances.
Yeah, because everyone's situation is different.
Right.
So you need a plan that fits you.
Right. And they can also help you to stay disciplined.
Ooh, that's a big one.
Which, let's be honest, is one of the hardest things to do as an investor.
It is. Because there's so much noise out there.
Right. You want to avoid those impulsive decisions that are usually made based on fear or FOMO or greed.
Yeah.
Right.
Yeah. It's tough, but it's so important.
So those are classic loser's game moves, right? We want to play the winner's game. Okay, so I think let's start digging a little bit deeper into some of these key concepts from the book. Chapter 1, very appropriately titled The Loser's Game, really lays the foundation for everything else that's coming.
It does. It sets the stage perfectly.
Right. And it's where he introduces that tennis analogy and really hammers home this point. The stock market is dominated by institutions.
Yeah.
And that trying to beat these institutions at their own game as an individual is almost impossible.
You're fighting an uphill battle there.
Right. And he gives some really, really compelling data to back this up. He talks about how trading volume has skyrocketed. I mean, in the past century, we've gone from a few thousand shares a day
Wow.
to millions upon millions.
That's insane.
It's like the difference between, I don't know, playing checkers and competing in a high-stakes poker tournament. You know what I mean? Yeah. It's a completely different ballgame. And he's saying that if you cling to those old rules of active investing, buy low, sell high, try to time the market, it's most likely going to lead to, disappointment, frustration, and frankly, losses.
Lost money. Nobody wants that.
Nobody wants that.
Yeah.
So what's the solution? Well, that's where chapter 2 comes in, the winner's game. And Ellis lays out his philosophy where you're shifting the focus from the market to the investor. So he's saying one of the key takeaways from this chapter, you really need to understand your own strengths and weaknesses as an investor.
Oh, yeah. Self-awareness is huge.
Right. What are you good at? What are you not good at?
Yeah.
And how can you kind of leverage those strengths? And more importantly, how can you mitigate those weaknesses?
Yeah.
He has this great quote, and I think it kind of sums it up.
Let's hear it.
When investment advisors guide investors to investment programs that are right for the individual client's investing skills and experience, financial situation, and tolerance for risk and uncertainty, most investors can achieve their own realistic long-term objectives.
That's a mouthful, but it's so true.
Right. It's about finding an investment strategy that really fits you, not trying to force yourself into a mold that doesn't.
Yeah. It's like trying to fit a square peg into a round hole. It's just not going to work.
Right. It's not one size fits all. And that's where a financial advisor, again, can really help you. They can help you identify those strengths, understand your true risk tolerance, and develop a plan that is aligned with your goals.
Yeah, because I think a lot of people, they think they know their risk tolerance.
Right.
But when the market actually starts going down, they're like, oh, wait a minute. I'm not as comfortable with this as I thought I was.
Right, exactly. And they can help you avoid those common pitfalls that trip up so many investors.
Oh, yeah.
Emotional reactions to market swings, chasing hot stocks,
Yeah.
trying to time the market, all those things that we think we can do.
Right. All those losers game moves.
Exactly, exactly.
You got to get out of that mindset.
Speaking of those losers game moves, let's talk about chapter 3, the power of time and patience. And I think you and I both agree that this is such a key element of successful investing.
It's crucial. It's everything.
Really is. And it's where Ellis emphasizes thinking long-term and avoiding those knee-jerk reactions to every little market blip. Because they're going to happen.
They're going to happen. And, he throws out a statistic that's really, really mind-blowing.
Oh, yeah.
He says that if you had removed just the 5 best days from 72 years of stock market history, your returns would have been cut by nearly 50%.
It's incredible.
In just 5 days. That's all it takes.
It's all it takes, right. So trying to time the market, it's a fool's errand. You're going to miss those, and it can have a significant impact on your long-term gains.
And you're never going to know which 5 days they are.
Right, exactly. So you have to stay invested.
You gotta be there when lightning strikes.
Right, you got to be there when lightning strikes.
Exactly. And, this doesn't mean just blindly holding on to any stock forever. You still need to do your research. You need to find those companies that you believe in, that you think are going to be around for a long time.
Right.
Once you've made those decisions, you've got to have the patience to stick with them.
Right.
Let them ride.
And that's hard. It's hard to do sometimes. But
it is. Human nature is to want to, jump ship when things get scary.
Exactly.
But that's usually the worst time to do it.
Right, okay. So, Chapter 4. Understanding Mr. Market. This is where Ellis introduces one of Warren Buffett's most famous analogies. Have you ever heard of this?
Oh, of course.
Mr. Market.
Mr. Market. Everyone knows Mr. Market.
Okay, good. So, I'm not talking crazy. So, picture this eccentric character who shows up at your door every day.
Right.
And offers to buy or sell you stocks at these crazy fluctuating prices,
Yeah. I can see him now.
Right.
He's got a briefcase and a newspaper tucked under his arm.
Exactly.
And he's sweating and nervous one day, and then the next day he's all excited and giddy.
Right. And Ellis is saying you should not let Mr. Market's mood dictate your decisions.
Oh, definitely not. Mr. Market is crazy.
He's a little crazy.
You can't let him run your life.
Right. And you need to separate his emotions from the actual value of the businesses that you've invested in. So, smart investors, they recognize that market fluctuations are normal.
What happen?
They happen.
All the time.
Right. So don't let those derail your long-term strategy.
Just noise. Just noise.
Just noise. And that's where that concept of regression to the mean comes in.
Yeah.
It's the idea that those extreme highs and lows tend to even out over time.
They always do.
Right. Huh. So if a stock or the market has had this huge run up or decline,
right,
it's probably going to go back to its average. It's like a rubber band. You know what I mean? You stretch it out and it will eventually snap back to its original shape.
Yeah, exactly.
So how do we kind of take this and apply to our own investing? Well, don't overreact.
Yeah, easy to say, hard to do.
It is. It is. I mean, I do it all the time.
Oh, we all do. We all do.
If the market takes a sudden dip, don't panic and sell everything. Remember, Mr. Market is just having a bad day.
Right.
Right. So focus on the long term, and are those businesses that you've invested in still sound? If they are, no need to hit the panic button.
Yeah, just ride it out.
Right.
The storm will pass.
Okay, so let's get to the heart of the winner's game strategy.
All right, lay it on me.
Chapter 5, Index Funds and Why They Work. And this is where Ellis makes a pretty bold claim, and I'd love to get your thoughts on this too.
Okay.
He's saying that because the market is so efficient now,
right,
trying to beat it consistently is nearly impossible.
Oh, I agree with that 100%.
Right.
I mean, there are very few people who can do it consistently, and even they, they have their off years.
Right, and he's saying, especially for individual investors,
right.
So what's his solution? Index funds.
Makes sense to me.
Right.
Because you're basically, instead of trying to beat the market, you're trying to match it. And that might sound boring to some people.
Right.
But, if you think about it, if you can match the market's return, you're doing pretty well.
Right.
And you're doing it without all the stress and the hassle of trying to pick individual stocks.
Right. And, he actually argues that accepting the average return by matching the market, it leads to superior long-term performance for most investors.
I think that's absolutely true.
Because you're taking the emotion out of it, Yeah. You're not second-guessing yourself. You're not chasing hot stocks. You're just kind of riding the wave.
And you're not paying all those high fees that you would with an actively managed fund.
Right.
Where they're trying to beat the market and they're charging you a premium for that.
Exactly. And most of them don't even beat the market.
Exactly. So you're losing twice.
Right.
You're paying higher fees and you're probably getting lower returns. It's a lose-lose situation.
So it's a really empowering concept. It's like you don't have to be this, financial genius. To succeed in the market, you can simply invest in a broad market index fund.
Yeah, set it and forget it.
And let the market do the work for you. But, index funds are also great because they're incredibly diverse.
Oh, absolutely.
You're not putting all your eggs in one basket.
No.
Instead, you're spreading your risk across hundreds, even thousands of different companies.
Diversification is key.
Right.
That's how you protect yourself from those big losses.
Exactly.
Because if one company goes down, it's not going to take your whole portfolio down with it.
Right. And they tend to have, significantly lower fees.
Oh, yeah.
Than those actively managed funds.
Way lower.
So you keep more of your returns.
It's a no-brainer.
Right.
Really. when
Yeah.
you think about it that way.
It really is. And, he uses this analogy of the tortoise and the hare,
Hmm.
you know? Slow and steady wins the race.
I love that analogy.
Yeah.
It's so true. You don't have to be flashy or try to get rich quick. You just need to be consistent and disciplined
Right.
and let time work its magic.
Okay, so let's shift gears a little bit, and let's talk about Chapter 6, Managing Risk and Behavioral Economics. And this is where Ellis dives into the psychological side of investing. And I think this is so fascinating because it's something we don't talk about enough.
Oh, for sure. We're all human. We all have these biases, and they definitely impact our investing decisions.
Right. He's exploring how our own biases can lead us to make, let's be honest, some pretty poor decisions sometimes.
Bad decisions, expensive decisions.
Right, exactly. So he uses the field of behavioral economics to illustrate some of the common traps that investors fall into. Have you ever heard of the illusion of control?
Oh, yeah. We all think we can control things more than we actually can.
Right. So it's that tendency to overestimate our ability to influence events. And especially, I think it's tempting in the market because, we're the ones hitting the buy and sell buttons. You know what I mean?
Yeah. It feels like we're in the driver's seat.
Right. And you think, I'm in control of this. I'm making these decisions.
Right. But the reality is the market doesn't care what you think.
Right. It's going to do its own thing.
It's going to do its own thing.
It's like thinking you can control the outcome of a coin toss,
Exactly.
just because you're the one flipping it.
Right. You could flip it, but you don't know which way it's going to land.
Right. And then there's hindsight bias. And this is the one where it's like you say, I knew it all along.
Oh, yeah.
After something happens.
It's so easy to say that after the fact.
Right.
But in the moment, you probably didn't know.
You probably didn't know.
You were just as clueless as the rest of us.
And this can lead to poor decisions in the future.
Yeah.
Because we start to think oh, I've got this figured out.
Right.
I'm good at this.
We start to get overconfident.
Right. Exactly.
And that's when we make mistakes.
Right. And then, of course, the halo effect. We tend to be swayed by the opinions of people that we admire,
Oh, yeah.
even if they're not experts in investing.
Celebrity endorsements.
Right.
They work, even if they shouldn't.
Right. Exactly.
Yeah.
And, it's like thinking that just because someone's a brilliant entrepreneur
Right.
or a famous athlete,
Or a musician.
yeah, that they must also be, this amazing financial whiz.
Right.
But investing is a specialized field.
It is. It takes a lot of knowledge and experience.
Right. And it's really important to seek advice from people who are qualified professionals.
Yeah, don't just take advice from anyone.
Your uncle at Thanksgiving or,
Or, some random person on the internet.
Exactly. So how do we avoid these behavioral traps?
Well, I think the first step is just being aware of them.
Right.
Knowing that these biases exist and that they can influence your thinking.
Right.
Once you know that, you can start to watch out for them.
Right. And it might mean taking a step back
Yeah.
before you make any major decisions.
Sleep on it.
Right. Sleep on it. Talk to a financial advisor. Bounce ideas off of somebody.
Yeah, get a second opinion.
Exactly. And I think the key takeaway here is that everyone is susceptible to these.
Oh, yeah.
This isn't I'm not smart enough or I'm not, experienced enough to
yeah.
avoid these. It's just human nature.
We're all human.
Right. So the key is recognizing them, managing them.
Yeah, don't let them control you.
Right.
Be aware of them and make conscious decisions.
Okay, so Chapter 7, the importance of whole picture investing. And this is where I love how Ellis encourages you to zoom out and look beyond just your stock portfolio.
Yeah, it's about the big picture.
Right. He wants you to consider your whole financial picture when you're making decisions.
Your whole life, really.
Right.
Because your investments are just one part of it.
Right. So we're talking income, expenses, assets, debt, future goals, even your expected lifespan.
Yeah, it's all connected.
Right. And it's like putting together a puzzle.
Yeah.
You need all those pieces to see the complete picture.
Yeah.
And he uses this example of a young MBA graduate just starting their career. And you would think, okay, someone in that position,
Yeah.
they want to play it safe.
Right. The conservative.
Conservative. But Ellis argues that because they have decades of potential earnings ahead of them.
Right. Time is on their side.
Right.
They can afford to take more risks. They have that long runway.
Right.
So they can be more aggressive.
Which is, I think, counterintuitive.
It is. It is.
Because you would think, oh, I'm just starting out.
Right.
I need to be super careful.
Right.
But he's saying, no, you have that time on your side. So factors like home ownership, future income,
Yeah.
your expected lifespan,
Yeah.
those should all play into the decisions you're making. So
Yeah.
it's not a one-size-fits-all. Your investment strategy should be as individual as you are.
Exactly. We're all different.
Right. And that brings us to Chapter 8, bonds. A look at the current landscape.
Okay.
This is where Ellis gets a little controversial.
Oh, I love it when he does that.
Right. He doesn't sugarcoat his views. He just comes right out and says it. And in this case, he's saying that he thinks bonds are kind of a bad spot in today's market,
Yeah.
given their low yields.
Right, because with interest rates so low, the returns on bonds just aren't that great.
Right.
And there's also the risk that interest rates could go up,
Yeah, exactly.
which would mean bond prices would go down.
Right. And he's not saying the bonds are inherently bad,
Right.
but he just doesn't think that the current market environment is very favorable for them.
Yeah.
But, I mean, that's his opinion, right?
Right.
It's important to get multiple viewpoints,
Always.
always. And do your own research
Absolutely.
before you make any decisions.
Don't just take one person's word for it.
Okay, so Chapter 9, planning your play and practical tips.
All right.
This is where Ellis really gets into the details of developing a really solid investment policy.
Yeah, like a blueprint for your financial future.
Exactly. And he walks you through those key elements that you need to think about. Investment objectives, risk tolerance, time horizon, spending needs, tax implications.
The whole 9 yards.
The whole 9 yards.
You got to consider it all.
Right. And he really stresses the importance of sticking to your plan.
Ooh, discipline.
Discipline, even when the market is going crazy.
It's hard,
It's hard.
but so important.
Right. And he says, the biggest risk in investing is almost always the short-term behavior of the investor.
It's true.
Right. We get scared, we sell, we buy the wrong time.
I panic.
We let our emotions get the best of us. So having that plan is like having a GPS for your finances.
I love that.
Right. It keeps you on track, and it helps you avoid making those wrong turns that can lead you astray.
Because we all make wrong turns sometimes.
We all do.
But if we have that GPS, we can get back on track.
Okay, so Chapter 10, mutual funds.
Yeah.
Selecting the right ones. Oh. And this is where Ellis, I think, challenges the conventional wisdom a little bit.
Oh, yeah. He's not afraid to shake things up.
Right. He's suggesting that instead of obsessing over past performance, which, let's be honest, is often a really poor predictor of future returns.
Past performance is not indicative of future results.
Right. You should focus on finding a superior investment organization that aligns with your values and has a strong track record of attracting and retaining top talent.
Yeah, it's like choosing a doctor.
Right.
You're not just going to go to the doctor who's the cheapest or the one who's closest to your house.
Right, exactly.
You want the best doctor.
Right, exactly.
The one who's got the best experience, the best credentials, the best bedside manner.
Exactly.
It's the same with investing. You want the best people managing your money.
Right. And I think he brings up a really good point here. You know, he's like, look for funds that have low fees.
Oh, yeah. Fees are huge.
Right. And where the managers actually invest their own money.
Skin in the game.
Skin in the game.
That's what you want.
You want them to have skin in the game because, you know.
If they're putting their own money in it, you know they believe in it.
Right. Exactly.
They're not just going to gamble with your money.
Okay, so let's talk about fees. Something that can make a huge difference in your long-term returns. Chapter 11, fees. Why they matter so much. And Ellis really emphasizes that even small fees can significantly erode your returns over time.
Oh, yeah. Host speaker, welcome back to our deep dive into winning the loser's game.
All right, so let's kind of keep unpacking this winner's game strategy.
Okay.
And in the last part, we were talking about how individual investors often make the mistake of playing the loser's game, right? Trying to outsmart the market.
Yeah, trying to beat the pros at their own game.
Right, instead of focusing on really what they can control.
Exactly. And that's why Ellis really dedicates a whole chapter to this concept of the winner's game.
Yeah.
Wants to shift your focus away from trying to beat the market and more onto just achieving your own personal financial goals.
And I love how he uses the example of a financial advisor as like a coach in the game.
Oh, yeah, that's a great analogy.
You know, it really helps to visualize it, you know, that role that an advisor can play in helping you kind of get to where you want to go.
Yeah, because they're not just picking stocks for you, right?
Right.
They're helping you to understand the game. They're helping you to understand the risks. They're helping you to set realistic goals. You know, it's a much broader, more holistic approach.
And that kind of leads perfectly, I think, into Chapter 3, the power of time and patience.
Oh, yeah, that's a big one.
Right. Remember that statistic we mentioned about removing the 5 best days
Oh, yeah.
from 72 years of stock market history?
That was crazy.
It blew my mind. It really, to me, drove home that point that trying to time the market is almost like an impossible feat.
It is. It is. It's luck, basically.
Yeah.
If you get it right, it's pure luck.
And even if you get it right most of the time, you miss those few days. And it can have a huge impact on your long-term returns.
And you don't know which days they're going to be.
Right.
So you got to be in it to win it.
So it's not about, not just about being in the market. It's about staying invested.
Yeah.
Right. Even when things are a little,
Bumpy. Yeah.
Scary.
Yeah. When you see those headlines, markets crashing, and you get that feeling in your stomach.
Yeah, exactly. But that's where I think discipline and patience really come in.
For sure.
Right.
Yeah.
Remembering that, the stock market's like a roller coaster. There's going to be ups, there's going to be downs.
Yeah.
But if you have a plan, if you stick to that plan, chances are you're going to make it to your destination safe and sound.
You're going to get there eventually. And, that kind of brings us to Chapter 4, I think, Understanding Mr. Market.
Yes.
Which is one of my favorite parts of the book.
I love that analogy.
It's brilliant. It really is.
I think it really, helps us to humanize the stock market in a way.
Yeah.
Because, let's be honest, sometimes it feels like it has a mind of its own.
It's got its own personality.
It really does. So, just to remind everyone.
Yeah.
Mr. Market is that fickle character who shows up at your door every day.
Yeah.
Offering to buy or sell you stocks at these crazy fluctuating prices,
Yeah, sometimes he's euphoric.
True.
And he's offering you way more than you think your stocks are worth. And then other days he's down in the dumps and he's trying to sell you stuff for pennies.
Right. And the key is not to let his emotions dictate your own decisions.
Right, because his emotions are all over the place.
All over the place. He doesn't know what he's talking about half the time.
Half the time, no. So you gotta keep your head. Stay focused on the fundamentals.
Right. You got to recognize that his mood swings are temporary.
They are.
Focus on the value of the businesses that you've invested in.
Right. Because in the long run, that's what matters.
Exactly. And that's, I think, where that concept of regression to the mean comes in.
Yeah.
It's the idea that, those extreme highs and lows, they tend to even out over time.
They do. It's like a pendulum. It swings back and forth.
It swings back and forth.
But eventually it comes back to the middle.
So if a stock, or the market in general, has had this huge run-up or a decline, it's likely to go back to kind of where it normally is. So how do we apply this to our own investing? Don't overreact.
Yeah, don't panic.
Right. If the market takes a sudden dip, don't just sell everything.
Yeah, you're just going to lock in your losses that way. You got to give it time to recover.
Give it time to recover. Mr. Market is just having a bad day.
He's having a tantrum.
He's having a tantrum, right?
Yeah.
So focus on the long term.
Yeah.
And if those businesses, you did your research, you invested in those businesses, they're still sound. No need to hit the panic button.
And this kind of segues nicely into the next topic, which is Ellis's love for index funds.
Yes. Chapter 5, Index Funds and Why They Work. This is, I think, one of his most kind of controversial ideas.
It is. But I think it's brilliant because he's basically saying, look, trying to beat the market is, for most people, like he said, it's a loser's game.
Right.
So what do you do instead? You buy the market.
Right. You buy the market.
You invest in a low-cost index fund, like an S&P 500 index fund, for example.
Right. Which means that instead of trying to pick individual stocks or time the market.
Which is impossible, by the way.
Impossible. You're buying a slice of the entire market.
Exactly.
And he actually, he says that accepting average returns, essentially, by matching the market.
Yep.
It actually leads to superior long-term performance for, I think, most investors.
I think he's right.
Right.
Yeah.
And I think that's counterintuitive to what a lot of people think.
Oh, totally.
They want the home run. Yeah. They want that, 10-bagger.
Yeah, they want to get rich quick.
Right. But, the data shows.
The data shows.
It's not that easy.
No, it's not. And, index funds, they take the emotion out of it.
Yeah.
Which is, I think, a huge benefit for a lot of people. Because we're all emotional creatures.
Right. We get scared. We get greedy. We
make bad decisions.
We make bad decisions. And that's why I think this idea is so powerful. Because it's like, okay, you don't have to be this financial genius,
right?
To succeed.
Yeah.
You can simply invest in a broad market index fund and just kind of let the market do its thing.
Let it ride. And the other great thing about index funds is that they're incredibly diversified.
Yes.
So you're not putting all your eggs in one basket.
Right. You're not betting on one company, one sector.
Exactly. You're spreading your risk across the entire market.
Which is a really, really good way to mitigate risk.
It is. It is. And, the other thing is index funds, they tend to have much lower fees.
Way lower.
Way lower than actively managed funds.
Right.
And over time, those fees can really eat into your returns.
They can.
So if you're paying less in fees, you're going to keep more of your money.
So if you're looking for a simple, low-cost, and effective way to invest, index funds, I think, are really worth considering.
Yeah, I think Ellis would definitely agree with that.
Okay, so now let's kind of switch gears a little bit and explore Chapter 6, Managing Risk and Behavioral Economics. This is where Ellis gets into the psychology of investing.
Oh, yeah, this is a fun chapter.
It is. It's a fun chapter, and he's basically exploring how our own biases
Right.
sabotage our decisions.
They really do. I mean, we all think we're rational, but, deep down we're not.
Right.
We're all influenced by these little mental shortcuts that our brains take.
Right. He highlights a bunch of different biases, like,
Yeah.
The illusion of control, that, like we were talking about earlier, thinking we have more influence over the market than we do.
Yeah, that's a classic one. I've definitely fallen prey to that one myself.
Oh, yeah, me too.
Especially when you first start investing,
Right.
You think you're going to, outsmart everybody and make a killing.
Yeah.
But then reality sets in.
Reality sets in.
Hmm.
And then there's hindsight bias. It's that feeling of, oh, I knew it all along,
Oh, yeah.
after something happens.
We're all experts after the fact, right?
Well, right.
But in the moment, we're just guessing like everybody else.
And then, of course, the halo effect.
Yeah.
Where we are swayed by opinions of people that we admire.
Oh, for sure.
Right. Even if they have, no idea about investing.
Right. Just because somebody's famous or successful in one area
Yeah.
doesn't mean they know anything about investing.
Right. So how do we avoid these behavioral traps? I think step one is being aware of them.
Yeah, awareness is key. Once you know that these biases exist, you can start to watch out for them.
Right.
You can start to question your own thinking,
Right.
and maybe slow down a little bit,
Yeah.
Don't make any rash decisions.
Take a beat.
Yeah, take a beat.
Maybe talk to your financial advisor.
Yeah, get a second opinion.
Get a second opinion. And I think, the key takeaway here, and I want to stress this, that everybody is susceptible to these biases.
Oh, yeah.
This isn't a matter of intelligence.
Right.
It's human nature.
It's how our brains are wired.
Right. So recognize them,
Yeah.
manage them, and don't let them kind of sabotage your long-term goals.
Don't let them get in the way of your success.
Okay, let's talk about Chapter 7, the importance of whole picture investing.
Okay.
This is where Ellis encourages you to kind of zoom out and look beyond just your stock portfolio.
Yeah, big picture thinking again.
Big picture thinking.
Oh, yeah.
He wants you to consider your entire financial situation when you're making these decisions.
Their whole life. Right.
Income, expenses, assets, debt, goals, even your expected lifespan.
Yeah. It's all connected. And it's like putting together a puzzle, right?
It is.
You need all the pieces to see the whole picture.
You need all the pieces. And he uses the example, which I think is really interesting, of a young MBA graduate just starting their career.
Yeah.
And you would think that someone in that position would want to play it safe.
Right. Be conservative.
Be conservative.
Yeah.
But Ellis says, no.
Yeah.
You've got decades of potential earnings.
Time is on your side.
You got time on your side.
You can afford to take more risk.
You can be more aggressive. I think that's counterintuitive.
It is. It is. But it makes sense when you think about it.
It does.
Because, you have a long time horizon. You can ride out those market fluctuations. You can afford to be more aggressive.
So things like home ownership, future income, lifespan, those should all play into it. So it's not a one-size-fits-all. Your investment strategy should be as individual as you are.
Exactly.
Which brings us to Chapter 8, bonds. Look at the current landscape. And this is where, Ellis gets a little controversial.
He loves to do that.
I know. And he comes out and he says it. He's basically saying, I think bonds are kind of a bad spot in today's market.
Yeah. He's not a big fan of bonds right now.
Given their low yields.
Yeah, because with interest rates so low, the returns on bonds are they're not that great.
Right. And there's the risk that interest rates could go up.
Exactly. Which would mean bond prices would go down.
Right. So he's not saying that bonds are inherently bad.
Right.
But he just doesn't think the current market environment is kind of favorable to them.
Yeah, he thinks there are better places to put your money right now.
Right. But again, it's just one perspective.
It is. It is. And, the bond market is a complex beast.
It is.
So, do your research, talk to your advisor, and make a decision that's right for you.
Get multiple viewpoints.
Always.
Always do your research.
Absolutely.
Okay. Chapter 9. Planning your play and practical tips. This is where Ellis gets into the nitty-gritty of developing a solid investment plan.
Yeah, he's giving you the tools you need to create a roadmap for your financial future.
Exactly. And he emphasizes the importance of considering, your investment objectives, your risk tolerance, time horizon, spending needs, tax implications. He's talking about creating that roadmap for your journey, right?
Yeah.
And that can help you, get to where you want to go, even if there's some detours along the way.
Because there will be detours. The market is going to throw you some curveballs.
Oh, it will.
There will be times when you're tempted to abandon your plan.
Right.
But that's when you got to stay disciplined. You got to remember why you made that plan in the first place.
And he says, and this is a quote that I think is so important, the biggest risk in investing is almost always the short-term behavior of the investor.
It's so true. We are our own worst enemies.
Right. It's that panic. We get scared,
Yeah.
we sell low,
Yeah.
we buy high, we just, those emotions.
Yeah, we let our emotions get the best of us.
So having that plan is like having a compass.
I love that.
Right.
It keeps you pointed in the right direction.
Right. It keeps you pointed in the right direction, even when, the terrain gets a little rocky.
Ah.
So, okay, let's talk mutual funds. Chapter 10, mutual funds, selecting the right ones. And this is where Ellis, again, kind of challenges the conventional wisdom
Yeah.
a little bit. He's suggesting that instead of, just looking at past performance,
What is a terrible way to choose a mutual fund?
terrible,
Mm-hmm.
which can be, very misleading. You should focus on finding a superior investment organization,
Mm-hmm.
one that aligns with your values,
Yeah.
that has a strong track record of attracting, retaining, top talent.
Mm-hmm.
And it's kind of like he says, it's like choosing a surgeon. You're not just going to pick the one with the highest success rate.
Right.
You're also going to consider their experience, their credentials,
Yeah.
their approach,
Your bedside manner.
their bedside manner.
Exactly.
Exactly. So, and he also brings up this point about looking for funds that have low fees.
Oh, yeah. Fees are huge.
Fees are huge. And where the managers actually invest their own money,
Skin in the game.
skin in the game.
That's what you want. You want them eating their own cooking.
Right.
Because if they're not willing to invest in their own funds, why should you?
Okay, and speaking of something you can really eat into those returns, Chapter 11, fees.
Mm-hmm.
Why they matter so much.
Mm-hmm.
This is like Ellis really hammers home that even small fees can significantly erode your returns over time,
Mm-hmm.
especially when you think about it being compounded over many years.
Oh, yeah.
It's like, I always use this analogy, it's like a small leak in a boat,
Yeah, I like that.
right? It doesn't seem like a big deal at first,
Right.
but over time, it can sink the whole ship.
Yeah, it's death by 1,000 cuts. A
Exactly.
little bit here, a little bit there.
And he points out, I think this is so interesting, that investors often pay more for those lower value services like frequent trading,
Yeah.
than for actual long-term guidance.
Right. They're paying for all the bells and whistles, but they're not getting the actual advice that they need.
Right. It's like paying a premium for a fancy sports car,
Yeah.
but never taking it out of the garage.
Right. What's the point of having it if you're not going to drive it?
Right. So, be mindful of those fees and understand how they can impact your returns.
Yeah. Fees are a silent killer.
Okay, so Chapter 12, disaster, again and again. This is where Ellis takes us on a bit of a history lesson, exploring the cyclical nature of, these market meltdowns. He's talking about the dot-com bubble, the 2008 financial crisis, even the more recent, pandemic-induced crash.
Yeah. He's basically saying, look, these things happen,
They happen.
then they're going to keep happening.
Right, so don't try to predict them, don't try to avoid them, because you can't.
It's impossible.
It is. It's like trying to predict when an earthquake will hit. You might have some general ideas, but you're never going to know for sure. And he actually says that, the biggest risk for individual investors isn't the market dropping.
Yeah.
It's actually panicking and selling at the bottom.
Oh, yeah. That's when you really get hurt.
Right. You miss out on that eventual recovery,
Exactly.
and it's human nature. I get it.
Oh, yeah. We all want to run for the hills when things get scary.
But that's the worst time to do it.
It is.
So you gotta stay calm.
Keep your head.
Keep your head. Stick to the plan. And remember, the market has always recovered from downturns, and it will again.
It always does, eventually.
Eventually. Now, let's shift gears. Talk about something that has become, I think, a cornerstone of retirement planning for so many Americans.
Okay, what's that?
401k plans. Chapter 13, 401k plans, getting yours on track. Ellis dives into the world of 401ks, and he's acknowledging, I think he's a fan of them, but he's also acknowledging that they have some flaws.
Yeah, he's not afraid to point out the downsides.
No, he's not. He points out that often they leave those crucial saving and investing decisions up to the individual participants.
Right.
Who, let's be honest, we're prone to mistakes.
We are. We're human.
We're human. And it's like giving a teenager the keys to a Ferrari and hoping they're going to drive responsibly.
Yeah, that's not going to end well.
It's not going to end well. But Ellis, he's not just pointing out the problems, he's also offering some practical advice.
Okay, good.
Right. For making the most of your 401k. Take advantage of employer matches.
Yeah, that's free money.
Free money. Invest in low-cost index funds.
Always a good idea.
Always a good idea. And he highlights this behavioral economics concept of opt out rather than opt in.
Oh, I like that.
Right.
Make it automatic.
Make it automatic.
So people have to actively choose not to save for retirement.
Which I think, and he brings this up.
It works?
It worked.
It really does.
Yeah.
Because people are lazy, They're not going to go out of their way to do something that's good for them.
Right.
But if you make it easy for them, they'll do it.
And then finally, he wraps it up.
Yeah.
Chapter 14, your end game, legacy and philanthropy. I think this is a really beautiful chapter.
Yeah, it's a good one.
It's a good one. It's really encouraging us to think beyond our own lifetime, right?
Yeah, think about the bigger picture.
The bigger picture. How can your wealth be used to benefit others?
Yeah. Leave a legacy.
Leave a legacy, right.
Yeah.
Make sure your money's going to the people, the organizations that you want to support, while minimizing the tax burden, which is a whole other, conversation.
Mm-hmm.
And he highlights some tax-efficient strategies like annual gifting, charitable trusts.
Yeah. Good stuff to know.
Good stuff to know. So I think, we've covered a lot of ground here in part 2.
Ooh.
We've explored Ellis's key concepts.
We've talked about the loser's game, the winner's game, the importance of patience and discipline.
Understanding those biases.
Oh, yeah, our own worst enemies. We've touched on some of his more controversial ideas, like his love for index funds and his skepticism about bonds.
Right. So in the next part, we're going to shift our focus to the practical application of these ideas.
All right, let's get practical.
Let's get practical, right? How can you, listening out there, how can you actually use these insights to develop your own winning investment strategy?
Yeah, how do we put this into action?
And achieve those long-term financial goals? So stay tuned for part 3, where we bring it all together. Welcome back to the Deep Dive.
We spent the last 2 parts really digging into winning the loser's game. We've talked about how, the investment landscape has changed, the importance of playing that winner's game, and all those fascinating psychological biases.
Yeah, those biases.
That can really trip us up.
They can.
So now I think, let's shift gears and talk about, how you can put this into practice. How can you, as an individual investor, use these insights to create your own winning strategy? Well, I think one of the biggest takeaways from winning the loser's game is that you need to focus on what you can control. You can't control the market.
Nope.
Can't predict the future.
Right.
But you can control your own behavior.
Yeah.
You can control your savings rate, your asset allocation, your costs, your reactions to those market ups and downs.
It's about taking ownership, right?
It is. It's about taking control of your financial destiny.
Instead of just kind of letting the market dictate the outcomes.
Exactly. And I think that starts with having a really good understanding of your own financial goals.
Mm-hmm.
Like, what are you actually saving for? When do you need the money? How much risk are you comfortable taking? Once you have a good grasp of those things, then you can start to build a plan.
And that's where I think a good financial advisor can come in.
Oh, absolutely. Absolutely. Yeah. They can help you to articulate those goals, maybe help you figure out your risk tolerance.
Right.
Create a plan that is specific to your needs and your circumstances.
Right. And they can help you to stay disciplined, which, let's be honest,
it's the hardest part.
So hard.
It really is, especially when, the market is going crazy and you're seeing those headlines.
Yeah.
It's so easy to kind of get emotional and make bad decisions.
Right. And, Ellis really emphasizes that. He talks about patience, he wants you to think long term. Don't don't get scared by those short-term fluctuations.
Yeah, remember Mr. Market?
Oh, Mr. Market.
He's going to show up every day
He is.
with his crazy mood swings.
He's going to try to get you.
But smart investors, they don't let him get to them, right?
Right.
They know that those swings are temporary, they focus on the fundamentals, and they just ride it out.
They ride the wave. Keep your head.
Keep your head, keep your head. And, this kind of brings us to another important point from the book, which is the power of compounding.
Yes.
Right. The longer you stay invested,
The better.
the more your money has the potential to grow.
It's like a snowball.
Yeah.
Rolling down a hill, it starts small.
It starts small, but it gets bigger and bigger and bigger.
Exactly. And the more snow it picks up, the faster it goes and the bigger it gets.
Exactly. And time is your friend here.
Yeah.
The earlier you start investing,
The better.
the more time that snowball has to roll down the hill.
The more money you'll have in the long run.
Yeah.
Okay, so let's talk about one of Ellis's more controversial ideas, his advocacy for index funds.
Yeah, this is one of my favorite parts of the book, actually.
Right. So he's basically saying that trying to beat the market is it's a losing game for most investors. And his solution, index funds. Investing in those low-cost index funds that just track an index, like the S&P 500, right? Instead of trying to pick individual stocks or, time the market, you're basically just buying a piece of the whole market.
Exactly. You're not trying to be smarter than the market. You're
Yeah.
just accepting the market's return.
And he actually says that accepting those average returns can lead to superior long-term performance. And I know for a lot of people that can sound a little,
Ooh.
boring, unambitious,
Yeah.
But when you consider the high costs and the inconsistency of those actively managed funds,
Yeah, it starts to make a lot of sense.
it makes a lot of sense.
Because with an index fund, you're not paying those high fees.
Right.
You're not trying to outsmart the market. You're
Right.
just riding the wave.
So it's actually a very elegant solution, I think.
It is. It is. And, another benefit of index funds, they're super diversified. You're not putting all your eggs in one basket. You're spreading your risk across hundreds, if not thousands, of different companies.
Right. And, one of the things that I think is so important to remember, and Ellis really hammers this home in the book, is those fees.
Oh, yeah, fees.
Fees are a big deal. He has a whole chapter dedicated to them, Chapter 11, fees, why they matter so much. He's saying that even small fees, and sometimes we don't even realize how much we're paying in fees.
Right.
They can really, really erode those returns over time, especially when you're talking about compounding and over many years.
It's like a termite infestation.
Right.
You don't see it at first,
No.
but it's slowly eating away at your house.
Eating away at those returns. So what can you do about them?
Well, I think the first step is just to be aware of them, right?
Yeah.
Know what you're paying, look at the expense ratios of the funds you're invested in, and don't be afraid to negotiate fees with your advisor.
Right?
Because, you're the customer.
You're the customer.
You have a right to know what you're paying for, and you have a right to get a good deal.
Exactly. And I think, you often get what you pay for. Sometimes it's worth paying a little bit more.
Right.
For quality advice and management. But you don't want to overpay for services that you're not using.
No, absolutely not.
Or that aren't adding value. So I think, winning the loser's game, it's so much more than just picking stocks. It's about developing a winning mindset.
Yeah.
For investing. One that is really rooted in patience,
Yeah.
discipline, long-term perspective.
It's about taking control of your financial future.
Exactly. And you don't have to go it alone. A good financial advisor can be such a valuable partner on this journey.
Yeah. Find someone you trust, someone who understands your goals.
Exactly.
Yeah.
Someone who's going to be there to support you along the way. So go forth.
Go forth and invest.
Invest. Apply these principles and start playing the winner's game.
You got this.
You got this. That's it for our deep dive into winning the loser's game. We hope you found it informative and inspiring. We encourage you to check out the book and explore these ideas in more detail. Thanks for joining us.